invest better with winning stocks picked by our team of experts. Select a stock.
Welcome to the ARMR Report, guys and gals. Thanks for joining me at 8 o'clock Eastern Standard Time. I'm doing this a little bit different. Usually I'm on earlier, but I thought, what the heck, let's give the West Coast a break. All right, guys, listen, this is the ARMR Report. It stands for Algorithmic Risk Management Research. What that means basically is everything we do here begins and ends with managing our risk. Okay, and I'm going to explain that in a minute. This is quantamental investing. It's the combination of quantitative execution, where we use computer algorithms to tell us when to add stocks to a portfolio and when to subtract and raise cash. And we combine that with a fundamental foundation, and that's the information edge I'm trying to provide on these shows. Today what we're going to do is we're going to go over stock charts. This is an education video, so I'm going to share with you step by step and let you see the chart patterns of why I was buying these assets. Let's just say last week. We'll pick a couple of names from last week and we'll break down the charts. Now don't forget, all the information I'm sharing with you is information I use in my own personal portfolio and for investors whom I manage money for, and that's through our affiliation with Interactive Brokers. And the answer is yes, Chad. We work with Interactive Brokers. Okay, we manage assets through Interactive Brokers. So if somebody wants to follow the ARMR Portfolios, they can do that with that affiliation. Okay, if you have questions about that, feel free to reach out and give me a call. Nothing that I'm going to tell you tonight should you run out and do immediately. I don't know you. I couldn't possibly tell you what to invest in. I'd have to literally talk to you first. So on a YouTube channel like this, it's best for you to realize what I'm trying to do here is share my own knowledge, my own experience, and then take that information and make it your own. Do your own homework. Okay? I'm going to jump into our 7 steps of the ARMR investing way, if you will. And what we're going to do is focus on step number 3, the buy triggers. But I thought before I do that, what I would do with you guys is leap into a quick discussion about the world around us. There were some questions that ARMR Insiders had for me in the ARMR Slack room. So all day, if you're an ARMR Insider, what we do is we spend our day on a Slack chat where I let you guys know what trades I'm making, whether I'm buying or selling something, adding or subtracting, what conference calls I'm listening to. I share information throughout the day. And the whole community, it's really been great. You guys have been giving me, a lot of ideas, a lot of thoughts. And so we communicate like that throughout the day. And so one of the questions was from earlier this morning, how do I view all the unrest in the country as it's going to affect the stock market? And my thought was this morning, while it's very distressing and it's part of, what countries go through as they grow, it has nothing to do with the stock market. So I just wanted to share with you this thought. When it comes to news stories, what matters to the market and what doesn't, it can be very confusing. If you watch CNBC, everything matters, right? They're going on and on about the non-farms payroll number on Friday. Give me a break, guys. It means nothing. Everybody knows the number's terrible. Who cares? It doesn't drive the market. Not right now. This is a mechanical bull market. It's being run by the mechanics, which are central banks and the Fed, adding tons of liquidity. That undertow, that rip current of liquidity is what's driving the market. So the only stories that you have to care about are stories that would slow down that rip current. Okay? And you're not going to hear about a lot of them on CNBC. Okay? Don't forget, these guys, they're not running money, these anchors. right? They can't even own stocks. So all they're doing is trying to entertain. It's an entertainment network. It's not a network to give you information that'll help you make money in the stock market. It's an entertainment network to keep you glued to the screen with overly exuberant excitement when the market goes up and dire, consequences if the market starts to sell off. And that's not how money is run successfully. So completely disregard it. Feel free. Don't ever forget. They're just trying to entertain and get ad dollars. The only people I care about on CNBC, and I watch it during the day, are people who actually run money. I like Jim Cramer, right? He's got a real portfolio, charitable trust. I'll listen to what he has to say. They bring on Jeffrey Gundlach. I want to hear it. Guys who are running money. Everybody else, forget it. Okay? They're just chatting. It means nothing. So, news stories that slow down the rip current of capital is what we should be concerned about. Other than that, the bull market, the mechanical bull market continues. You asked me what would be a story that would slow down the rip current. This is the answer. And I know this is going to sound crazy, but it's exactly opposite what they teach you at university. Okay? If you start hearing about stories where the economy is doing better, where the unemployment number has gone down dramatically, where GDP numbers are much stronger than anybody thought, that would be a problem for the stock market. Okay? It's the exact opposite of what they teach you at university. It's got nothing. By the time the market is, the economy is ripping, the stock market's already run. And those numbers start to come out, and it means that the Fed and the mechanics of the bull market can back away. And then you get Wile E. Coyote right off the cliff. Stock market's running, and they forget, they don't know that the Fed's not there anymore. And then something happens, upset the apple cart, market craters. So those are the stories we're worried about. Not stories about Trump in China, not stories about unrest. It would have to be something dramatically more significant to stop this mechanical bull market. Okay? So today what we're going to talk about, I have these 7 steps I've written down for you guys. 7 steps to investing. Okay? Step 1 is the whiteboard. You do research on companies. I like to use William O'Neill's services, at investors.com. But you can find ideas anywhere. You throw them up on a whiteboard. You don't run and buy them just because you love an idea. That doesn't mean it's time to buy it. It's time to start looking at it, start doing research on it, and then using algorithms to help you find the right entry point. The market and the stock. The algorithms for the market and the stock. Don't forget our algorithms here in the ARMR report. Why I'm here talking to you is that I'm sharing with you our algorithms that we've built over the years to drive our risk management. So on the 24th of February, I came on this show. I said, guys, we went to 100% cash in our algo-only portfolio. And that tells us in all of our portfolios to start raising cash and raising stops. That was the very first day of the market crash. Then on the 23rd of March, I came on the show. I said, guys, the Fed's buying everything in sight. We're starting to put money to work in precious metal stocks. That was the beginning for us. So 7 out of 10 stocks follow the market. So the first thing you got to do is build your whiteboard of ideas and then find out where is the market in the cycle. And you want to buy weakness in that cycle. You want to sell strength in that cycle. Okay? So the market direction is key. So right now, where are we? We've got tons of names on our whiteboard, and we're looking for the hoof prints of this mechanical bull market. We've been in it for 2 months now. How long is it going to last? All right, well, the last time the mechanics put this amount of liquidity into the system was 2009. And by the way, they're putting even more liquidity into the system now than any time in history. But in 2009, they started quantitative easing, and the market went up for 15 months. before it had an 18% correction because the Fed stopped QE. Now, can there be a sell-off for a week or two in here? Absolutely. Absolutely. Don't get carried away with enthusiasm just because I'm telling you we're only in month 2 of a mechanical bull market. There could be sell-offs, 10% sell-offs. It happens. It happened twice during that 15-month period. The S&P dropped 8% twice. Okay? It'll happen at some point. But right now, what we're looking at, so number 2 on our list of steps to invest is where's the market? We keep testing the market. Let's see where it's at. We're having unbelievable breakouts in leadership sectors right now. Things are occurring to me as I'm watching the market trade. I'll give you an example. Sometimes a company will do make a secondary announcement. They're going to bring out new shares. It dilutes current shareholders. Stock drops usually 15%, and it takes a while for that stock to turn around and start going up again. Take a look at this chart. I just want to share this with you. Just take a look at this. That's not what I wanted to show you. All right, just a second. Give me a second. Make sure we get this right for you. Well, I'm a bit stuck here, so let me try something else for a minute. All right, I'm going to share with you a chart pattern that shows you a footprint of the bull market that we're in. Okay, it's pretty fierce right now. What I'd like to see there we go. All right, guys, can you see this? There you go. All right. Let's take a look. This is Facebook right here. That's not what I want to look at. Here's a stock, new issue, came public recently, called Fastly, F-S-L-Y. All right. The company did a secondary right here. Tiniest of pullbacks, rips to new highs. That's not normal. In a normal market, secondary takes time to digest. In the bull market we're in right now, secondaries are just an excuse to throw money at a situation. Take a look at this idea. One of our favorites, you guys will know this. Okay? Innovative Properties just announced a secondary. A couple days ago, they announced the secondary. The stock is now trading higher than it was the day before they announced the secondary. And the list goes on and on. This might not seem like a lot to you, but I'm telling you from 30 years of doing this, when you see secondaries come out and the stocks go straight up through it, that's a bullish hoof print. Okay? So the second thing on our list is market direction. And all we're seeing are leadership stocks blowing out. How about things like this? Our old friend Zscaler. Earnings announcements that are good, but are they this good? The stock's up 60-something% in 2 days. The number wasn't that good, guys. Not in a normal market. This is a mechanical bull market. And here's the next footprint that matters. You have to understand that something like 2/3 of the investors out there believe the market has to retest the lows of March. Believe that this is a bear market bounce. Okay? Sooner or later, all that cash in the sideline is going to realize that it's wrong. And so what a footprint will be, what a hoof print will be of that realization is that the market's going to start to grind higher with less volatility. And today was one of my favorite days for that. Because what did the market do? Small gain. Just ground higher. Open lower on news that didn't really affect the market, and then grind higher. Up 1/3%, up 0.5%. There'll be a series of days like this where everybody who's on the outside looking in is trapped, and they just keep going at it and going at it. The rest of us who've been long for the last 2 months get to reap the rewards. So now let's look at some chart patterns to figure out the next step is the buy trigger. We've got our whiteboard. We know the market's going in the right direction. We see hoof prints. So we go and look for the algorithmic entry points. And this is key. I like to share with you guys, ARMR insiders are familiar with this. I'm just going to walk you through it real quick. All right, this is the website, the ARMR report. If you're an insider, you click on up here, ARMR Insiders, it takes you into the back end where you could see the information provided. Okay? Whiteboard, risk monitor, cannabis covers, that kind of stuff. And we're going to go into investing rules of the road now. And the number one rule of the road right here I want to share with you. Every investment decision made on the trading desk begins and ends with the following thoughts. Will the action place us on the right side of statistics and probabilities? And is the reward worth the risk we're taking? And the best way to do that is to find the right buy point. Okay? We do use algorithms here to find buy points, and I'm aware that you can't do that. I mean, if you're an insider, you can, but if you're on your own, you don't have algorithms. I get it. So let's look at the chart patterns that get us excited and involved. I covered for you guys a couple weeks ago, just to refresh memories, the relative strength breakout. Right? The idea here where relative strength leads price. Right? And I showed you guys back then, this relative strength line right here, the blue line, okay, breaks out to a new high before the stock does. Okay? So right in here is where we were buying Spotify because the relative strength broke out before the price did, and you can see what happened. All right, let's look at Splunk as another example. We've already gone over these charts, so let's get to some new ones. Okay? Here's Splunk. We were buying Splunk on the gap up, by the way. We paid up for this. Gap up. Because we saw the relative strength make new highs well before the stock. Now the stock's at new highs. All right, so what are we doing this week? Well, I'm going to share with you the chart pattern of the utility stocks. What I'm looking for, this is my favorite approach. There's so many favorites. This is one of my favorite approaches. I like to buy weakness in the midst of strength. That's what we do at the ARMR report. That's the ARMR investing way. But my favorite thing to do is find out what caused the weakness. Is it stock specific? In other words, bad earnings announcement, underperforming, their fundamentals are no good, they're having issues with their software, whatever. Okay? If that's why the stock's down, no interest. I don't have any interest there. That might end up being a turnaround play 6 to 12 months later. But that's not the weakness I want. I want weakness. For instance, a virus breaks out and the market crashes. I don't want the virus, but let's say the market crashes for whatever reason. In this case, it is the virus, so let's just discuss it for a second. It drags down all the stocks. The first group that shows strength is the precious metal stocks. And let's take a look quick at the chart. It's going to help you understand where I'm coming from. In fact, I think I'm going to show you this chart. Let's take a look at Newmont Mining, okay? So what we had here, you can see my arrow, is weakness during the crash in the midst of an overall strong pattern right at the 200-day moving average. And we know that this weakness is caused erroneously. It's not because there's something wrong with Newmont, And it's not because there's something wrong with precious metals. It's because we had margin calls in the midst of a crash, and so the proverbial baby was being thrown out with the bathwater. So the first group to recover is the group that benefits most from the Fed intervention. Right? That's why we went there first. But look at the chart pattern. You can draw your downtrend line from up here. And you could say, there's your weakness for something that has nothing to do with the company. And when you break out of that downtrend, you see what the stock does. Now let's apply that theory to a utility, Dominion. Take the weakness from the market crash. And I'm just going to give you a basic theory, right? Theoretically, utilities went down during the market crash because people are going to stop paying the utility bill. Right? That's ridiculous, but the market is ridiculous. And it's our job to find out when the market has mispriced something. Okay? So I've got algorithms telling me it's time to buy utilities. I have an algorithm written literally for the utility index, XLU. When we drill down and look at it, it's the same kind of chart pattern as precious metals a couple months ago. Look at it again. Weakness because of an exogenous event, and now we break the downtrend. This is why we're getting long this group in here. This is Dominion, one of my favorite names in the group. But you could look at XLU. Exactly the same chart pattern. Just Dominion's the leader in the group. Breaking the downtrend. Now, let's layer in another thought. Utilities do well when interest rates are going down. Right now, interest rates are plummeting. The mechanical bull is being driven by the mechanics who are going to zero or negative interest rates around the world. That's why utilities are on the whiteboard. Because we know that group does well in an environment like that. And yet the stocks are down. They're mispriced. So the buy trigger is breaking that downtrend. And you can just go look at a couple names here. There's Duke. Duke Energy, same story. How about Southern Company? Same exact story. And that's the last piece to this puzzle. And we'll move on. I like to see chart patterns that are identical across the board in a group. Because then I know it's a group mispricing, right? It's not just one stock that's been destroyed. Maybe there's something wrong with that company, but the rest of the group's doing well. I'm not looking for those names. Those are turnaround stories, and we need longer time frames, and we need a whole different pattern to buy those. But what we see here is uniformity. Everything was treated the same. You know that's not right. All the stocks are being treated exactly the same. That's the footprint of algos that are just trading and not thinking. And so now what we see are institutions coming back into this group because it's undervalued. It's mispriced. That's why we're buying the stock. So there's an example of another chart pattern. You could put these names and these ideas on your list now. We have three really we've talked about. We talked about relative strength, making a new high before price. We've talked about turnaround plays where you use the Fibonacci speed resistance fans. And when you break that third downtrend, you start to get movement higher. We just did that in all of the cannabis stocks. And we made money in those names. I'm going to wrap up on this thought and I'll get to your questions. Why do we make money in the cannabis stocks even though Canopy Growth had a terrible announcement and the stock cratered? Okay. Here's Canopy Growth. This is where we bought the stock. This day right here, the 15th of May, at $15.51. We sold some right here on the 28th in advance of the earnings announcement. About 20%. We booked a profit on about 20% of the position, and we sell the rest on the bad news at 17 3/4 roughly, up from 15.5. This is why the buy trigger is so important, and you have to be disciplined and not chase stocks. The old adage goes like this: you make your money when you buy a stock, not when you sell it, because your buy trigger is key. And those are some thoughts for you of how to find the right buy trigger. Let's get to some questions. Okay. Butch, do you add to your portfolio on big names like Microsoft, Nike, Constellation, Disney, while being up on those? Okay, which would raise your account. Okay, I love that. I'm so glad you asked that question, Butch. Thank you for asking that question, because I'll tell you what. What you're asking me about is the second entry point. And we just had one on the precious metals. So let me walk you through it. It's so key not to chase stocks. But at the same time, as the bull market progresses, there's going to be less and less opportunity at the initial entry. All your leadership stocks are going to be way above their bases. And so you don't want to keep buying like the laggards, the guys that come out at the end. 3-4 months from now, whatever's coming out then is going to be late. So what we'd rather do is ride our winners and trade around the core. So when something runs up too much too soon, I'm in there in the Slack room saying, guys, let's book some profit on this. Take it off the table. And when it comes back down, let's add to it. So here's where I'm going to add to it. And take a look at this chart, because it speaks volumes. This is Newmont Mining. Okay, so we're in Newmont right here, around 40 and change, 41, I think it was. And it ran all the way up to here, right? So we're not chasing at any point here. And this is key. And let me just say this, Butch, real quick. Let me look at you and say this. I put my biggest position size on at the initial entry. I don't have any interest in pyramiding up, buying a little bit and see how it does. No. I want the biggest position size on at the initial entry, closest to my stop. Because that's part of that rule number 1, where the reward is worth the risk. If I'm close to my stop, the risk is small, the reward can be huge. I want all my money to work right then. Stock runs up. Let's look at look at the chart, okay? Stock runs up. We actually booked a profit right in here at the ARMR report. Right up here, I said, guys, and actually I think I'm going to share the other chart because I'll show you why I did that. I said, guys, look, we blew out the top side. This blue line right here is 3.5 standard deviations above the 200-day moving average. Let's put in 5 and see what it looks like. Okay, so right up here, we were about 5 standard deviations away from the 200-day moving average. So when we got up there, and I think 4 was the exact number, just for the fun of it, I'll keep messing around until I find the right figure. All right, we blow 4.5 probably is the right number, right? But it blew through 4 standard deviations above the 200-day, so we booked a profit right in here. And we did not add to it at all as it kept going up. We said, that's fine. We still have 80% of our position on in some cases. Some cases it was 90, some 75. I leave that up to you. Okay, we just added. We added back to our position in Newmont Friday at the end of the day, right on the 50-day moving average. So to answer your question, I'll add to something that's up big. I wait for it to pull back to the 50-day sometimes the 25-day, sometimes the 200-day. It depends on the structure of the chart and which one makes sense. In this case, for Newmont, it was the 50. And believe you me, the 50 will be my new stop now. If it breaks below the 50, I'm out of the stock. Thanks for playing. Made a lot of money. Done. If it rips higher from here, I've put my position on, I've added to my position, it rips higher again, maybe it gets to 4 standard deviations above the 200-day, and I sell a piece again, and I trade around the core. So that's how I would do that. Okay? You've loved my point of view, Butch. Thank you very much on the markets. I appreciate that, my friend. All right. Can you explain how Zoom is still chugging along? Politics for Dummies. How's Zoom still chugging along? I can't explain it, but I'll tell you that is a hoof print of a mechanical bull market. It's even a hoof print of a regular bull market. When stocks get into stratospheric runs, and that can last for a lot longer than you think. So it's almost, I don't care about owning Zoom, but I do watch it because it's almost like a litmus test for the market. How desperate are the guys who've missed the market to get in? And they're desperate, and it keeps ripping higher. As long as the leadership keeps running, we've got a bull market. When those stocks take it in the neck, you've got a problem. Okay? So that's how I use that, and I don't have any clue why it keeps running. I mean, animal spirits, you know. Okay, Bitcoin. Brad, go for it, my friend. Bitcoin's not my thing. I'm focused on gold and particularly silver at this moment. So we'll see how that does. All right, Jason, what do you think about the work chart? Let's take a look at it. Is that like a softball question, my friend? Are you doing me a favor there? I mean, I couldn't have more fun with this question. Thank you so much for asking it. All right. So here's the chart of Slack work, right? ARMR report. We added it at 23 3/4 on April 8th. It's now, skyrocketing, approaching its 4 standard deviation line above the 200-day, and it announces earnings. Is it tomorrow or is it Wednesday? I have to take a look. I know I tweeted it out today. I can't remember right now. So what am I going to do with the stock? It's ripping higher. We have huge gains in the stock in front of the earnings number. I'm probably going to do what I did with Canopy Growth, which is take a piece off the top in front of earnings. I'm not going to tell you what piece to take or even to do it because I don't know how big your position size is. I have a huge position size at 23.73. Because that's when I put the most amount of capital to work, when I'm closest to my stop. So now I've got some sizable gains, and I don't mind shaving it down some. It'll still be a big position, but I'll have taken some off the top in front of the news. What do I think about the chart from here? I mean, it looks phenomenal. I wouldn't buy it here, right? I'm not buying it here. I paid 23 3/4. So I wouldn't buy it here. But, who knows? The bull market's got the bit in its teeth. If they have a decent earnings announcement, sky's the limit. But, I'm just going to share this. This is not statistically proven. This is just from 30 years in the business. I find that this happens more often than not, but not statistically, so don't trade on this. But stocks that run up a lot before the earnings number tend to sell off on the news unless it's something unreal because the excitement's already in it. And so people sell the news. Now, if they tell us on the conference call that they had all of these monthly average users, they had this massive increase in subscribers, and they've been able to convert that to paying customers at a rate bigger than the street thinks, then the stock's going a lot higher. But if they say, yeah, we had a huge increase in free subscribers and we're still working on converting them, and any kind of conversation like that, stock probably sells off because it's already up, 50, 60% from the buy point. Okay? All right, Green Ghost, what do you think about martial law being declared by Trump? He's not going to declare martial law. I'm going to skip. But besides, I don't know, right? And I want to keep politics as far away from this conversation as we can possibly get it, because and I'm sure you guys are sick and tired of hearing about it. And it's impossible to know what Trump will or won't do, but I don't think there'll be martial law. And that really has no impact on my investing philosophy, because I can't possibly discount that. We'll just have to deal with that if we get it. I'll tell you one thing. I'm glad I have a nice big portion of my portfolio in precious metals on that day. All right. All right, Fastly we talked about. All right. Silver, Dan D. Silver is going to be the investment. I'll say it again, guys. I couldn't agree with Dan more. And, in case you think you're late to the party, there's only one thing you have to look at, and I'm going to share that with you right now. I know you can't see it yet, so let me pull it up for you. Okay, this is SLV. I don't own SLV. I don't like SLV. I don't like GLD. I don't think these assets actually have any real metals behind them in compared to how many shares have been created. But don't get me started on that. But look at this. This is the monthly chart of silver. It hasn't even broken out yet. We're just so early in this game. We're on this so early that it's a little bit mind-boggling the amount of money made already. But it hasn't even broken out yet. Just to give you an idea of how far behind silver is, take a look at gold. But gold's already taken off. And in a real bull market for the metals, silver eventually outperforms gold. Eventually. So keep that in mind. But please remember to do your own homework if you're going to buy anything, because we already own these names, right? I mean, we own them cheap. I'm not chasing any of them here. All right, Bush, do you continue to add your positions? Oh, wait, we already looked at that. Brandon, can you talk about a good chart you like right now? It's easy to see it once you're already in the profit area. All right, Brandon. All right, here's a thought for you. I'll leave it at this, and then we'll call it a night, guys. Let's take a look at a couple of recent additions to the portfolio just for you, Brandon, because you always ask me this question. All right. I always say become an ARMR insider, and you'll see everything we're doing. When we buy it, where we buy it, the price, what our stop losses are, and all those things. And you can join us in the Slack room all day long to see what we're trading. But I'm going to share these two with you because you're so persistent, my friend. All right. Tom, great day. I'm glad you had a great day, my friend. Glad you had a great day. We all did. It was another big day for the ARMR Portfolios. All right, Brandon, take a look at this. Oops, that's not what I wanted to show you. All right, so Cuervo, QRVO. All right, what I like about this stock right here is that we're seeing a huge breakout of a massive consolidation area going back to 2015. Okay, that's the weekly chart of QRVO. There's a gap up right here, okay, based on blowout in earnings. This is a 5G Internet of Things company. And then, of course, the sell-off and the market crash, creating a cup and a handle base, and we're still in that handle right now. I would like to see the relative strength line breaking out to a new high. It hasn't done that yet. But I suspect if it creeps up a little bit higher here towards the pivot point, you'll see this start to make new highs before the stock gets above 120. So there's a stock for you to take a peek at. And I also I'm a big fan of Akamai. Now, Akamai never really had a sell-off. That's how strong this stock is. Talk about a market leader. A very swift and small sell-off in the market crash, and it's making a nice pennant formation right up here in the 100 area. So those are a couple ideas for you. Hi-Ho Silver, John. That's right, my friend. Hi-Ho Silver. Hi-Ho Silver, boy, that's right. Okay, guys, those are my thoughts for tonight. Thanks for joining me. I look forward to seeing you guys again later in the week, certainly next weekend at 11:30 for the weekend review. You guys have a good night.